5 EMA and 8 EMA trading strategy. This is the simple strategy that uses 5 EMA and 8 EMA indicators. Best works in trending markets, and worst in non-trending markets. Here's how this strategy works. If the faster EMA, 5 EMA, crosses the slow EMA, 8 EMA, to the upside, then it's sign of an uptrend. If 5 EMA crosses 8 EMA to the downside, it's a sign of a downtrend. Trade entries are taken following the EMA crossover. Indicators, 5 EMA and an 8 EMA. Time frame, NETF. Strategy. You can use this strategy for any stocks, forex, and commodities. Buying rules. Wait for 5 EMA to cross 8 EMA to the upside. Buy at the close of the candlestick that close after the EMAs has crossed. Selling rules. When 5 EMA crosses 8 EMA to the downside, sell at the close of the candlestick. Take profit. Your profit to be set at least 3 times the risk on that trade. Or you can target to take profit at the previous SL, swing low, for a sell order and a previous SH swing high, for a buy order. How to manage a profitable trade. How to manage a profitable trade with the 5 EMA and 8 EMA crossover strategy. Well, maybe you can use. If trade moves in your favor and you want to lock in profits, the best option is to move stop loss and place behind the high or low of each subsequent candlesticks that forms. That means, for a short trade, move SL, stop loss, and place above the high the candlestick that continues to make LH, lower highs. For a long trade, move SL, stop loss, and below the low of each subsequent candlestick that continues to make HL, higher lows. Or if on the DTF, daily time frame, you may try to use a 50 to 80 point trailing stop. If on the 4 hours time frame, use 25 to 40 point trailing stop. Advantages. This is a simple, easy to understand, where the beginner will find easy to use. In very strong trending markets, you stand to make lots of profits when you ride out the trend. Truly a trend is your friend here. Disadvantages. This strategy performs very badly in the non-trending market. If you trade LTF like the 4 hours and daily, your stop loss is going to be huge, which means your risk is going to be big, so you have to trade small lots to keep your risk within your acceptable levels. EMA are lagging indicators, and so, every entry taken based on EMA is effective late, which means that price had already made a big move and you would not have entered into the trade at the start of the movie. Therefore, by the time this strategy delivers the signal to enter, the market may be due for a temporary reversal and maybe hit your stop loss. There are multiple ways to trade forex markets. You could be a long-term position trader or a swing trader depending on the time frame and length of your trades, but you can also be a scalper and use the scalping strategy. For that matter, there are many scalping strategies including the 1 minute and the 15 minute and the most popular of all, the 5-minute scalping strategy. In this article, we are going to learn a scalping strategy based on the 5-minute chart that has proven successful among day traders for the last few years. We'll look at the exact levels of entry, when to buy, when to sell, and every other thing that you need to know to trade profitably in the forex market. Let's begin by looking at an outline of the 5-minute scalping forex strategy. What is scalping? Before we delve into the details of showing you how to use the 5-minute forex scalping strategy, first, what does scalping actually mean? Essentially, a scalper looks to scalp out small profits multiple times a day by using predefined trading strategies. Basically, what a scalper does is to quickly analyze the forex charts, and then mark the entry and exit levels with the goal of finding minor price changes in a certain asset, a process that is done several times within the day. Crucially, to get the best results and to ensure you limit the risks of this form of trading, scalping also involves the use of various risk management tools such as the risk-reward ratio, trailing stop loss order, and the use of a forex risk calculator. The 5-minute scalping strategy, a 5-step guide. In the section below, we are going to show you a 5-step-by-step guide to one of the most widely used and effective scalping strategies out there, the 5-minute scalping trading forex strategy. Step 1. Load an anchor chart and identify its direction. The key premise behind this strategy is to trade only in the direction of the trend as we identify it. You need to go with the predominant trend while waiting for a smaller pullback. This is going to ensure that you only take the best trades and that you don't get whipsawed back and forth. The idea here is to get into the market in a shorter time period as the market pulls back with the predominant trend as the direction of the trade. As with any strategy, we always look at a higher time frame chart. For example, if you're trading on the 5-minute chart, you have your confirmation chart, which I basically call the anchor chart. In quote. An anchor chart is very important here, as it helps you to understand the direction of the trading. Here, we'll use the hourly chart, H1, as our anchor chart to dictate trading direction. This chart determines which way you are going to be trading. It helps you to know the best time to engage in buying or when you're going to be selling. On this chart, there are 2 exponential moving averages, EMA, the 8 EMA and the 21 EMA. The direction of each moving average indicator is typically an indication of the direction of the market.